Welcome to the new era of video creation with AI stock picking. Today's topic is Berkshire Hathaway. Here are contents. Berkshire Hathaway is not just a stock. It's an ecosystem of businesses and investments managed with extreme financial discipline. It's led by Warren Buffett and Greg Abel and offers exposure to insurance, railroads, energy, consumer goods, and a massive public equity portfolio. BRK is structured as a conglomerate with core wholly owned businesses like Geico, BNSF Railway, and Berkshire Hathaway Energy. It also owns large equity stakes in companies like Apple, Coca-Cola, Bank of America, and Occidental Petroleum. These investments alone account for hundreds of billions in value. What makes Berkshire especially compelling is its war chest, over $160 billion in cash and treasury bills. This gives it the flexibility to make opportunistic purchases during market downturns. Buffett's mantra of buying when others are fearful still defines the firm's behavior. For investors who want a sleep-well-at-night stock that compounds wealth slowly and steadily, Berkshire is a top candidate. It's conservative, defensive, and designed to endure recessions. However, even Berkshire isn't immune to valuation concerns. Like any stock, it can become overbought, especially after strong runs. That's why this presentation focuses on identifying a smart buy zone, one that gives investors exposure to quality without chasing price. As of May 2025, BRKB trades around $395 to $405 per share. The valuation is about 1.5 times book value, a level that historically marks the upper end of Buffett's reasonable range. At this level, Berkshire is not overpriced, but it's not a clear bargain either. One thing to note is the rising proportion of Apple in its equity portfolio. Apple now accounts for approximately 45% of Berkshire's stock holdings, meaning BRK performance is increasingly tied to the trajectory of a single tech company. While Apple is solid, it introduces more volatility than the traditional Berkshire investor may expect. Meanwhile, Berkshire's cash stockpile continues to grow, now exceeding $160 billion. While this provides a huge margin of safety, it also reflects the challenge Berkshire faces in finding attractively priced deals at scale. The inability to deploy that capital efficiently creates opportunity cost. Overall, the current price reflects strong fundamentals but limited short-term upside. Investors who buy today are paying a fair price but not a discounted one. That's why identifying a better entry point, below historical multiples and closer to book value, could significantly improve your margin of safety. The sweet spot for buying BRKB is between $360 and $375 per share. At this range, the stock trades closer to 1.3 to 1.35 times book value, which is in line with its long-term historical average. That valuation represents Berkshire as a quality compounder, but without paying up for optimism. This price range typically coincides with broader market weakness, especially when Apple dips, or when economic worries hit cyclicals like railroads or energy. That's when Berkshire often looks boring and underperforms flashy growth names, creating ideal conditions for patient value investors. It's also important to note that Warren Buffett and Berkshire have repurchased shares most aggressively when BRKB traded below 1.4x book value. That buyback behavior gives you a floor. Management will likely support the stock at lower levels, adding to shareholder value. Buying in this zone gives you better downside protection while still participating in long-term upside from both operating businesses and the equity portfolio. With strong cash flow, low debt, and disciplined capital allocation, Berkshire doesn't need explosive growth to be a great investment. It just needs to be bought well. While Berkshire is a great business, it's not always a great buy. Right now, with the broader market near all-time highs in tech names, especially Apple, driving a lot of the upside, BRKB is trading at a premium. That leaves less cushion if earnings or market sentiment falter. One underappreciated risk is Apple concentration. If AAPL drops sharply due to regulation, slowing growth, or margin compression, it disproportionately impacts Berkshire's equity portfolio. That makes BRKB more correlated to big tech than its industrial-like business mix suggests. History shows us that BRKB tends to pull back during broad market corrections, often between 5 to 10%. That's when Buffett typically steps in with buybacks, offering price support. Savvy investors can follow the same logic: don't buy at highs, wait for weakness. Also consider that Berkshire's huge cash pile, while a strength, also indicates that opportunities are scarce. If Buffett himself is not deploying capital aggressively, it makes sense for outside investors to be just as cautious. In short, Berkshire is an amazing long-term hold, but buying at a better price is how you maximize that long-term return. Berkshire Hathaway is one of the best long-term wealth builders available. It's not flashy, but it's durable. It doesn't double overnight, but it compounds wealth steadily with less drama. It's backed by cash, profits, and management that allocates capital better than almost anyone. But that strength also means the stock can be deceptively expensive during bull markets. You don't want to pay a premium for a company built to be conservative. That's why the 360-375 range is ideal. It's where you get quality at a reasonable price, with a clear margin of safety. Buying Berkshire isn't about betting on AI or chasing growth. It's about trusting a balance sheet, a management team, and a business model that has outperformed for decades. But even great businesses have better and worse times to buy. So wait for dips. Wait for fear. Let market corrections, Apple sell-offs, or rate-related panics give you an opening. Then buy. Not because it's exciting, but because it's sensible. In a world full of hype, Berkshire is the adult in the room. Be the investor who acts like one too.